There are 6 common myths that inexperienced investors believe that either stop them from getting started investing or make them want to give up investing. The first and probably the most damaging is that a stock price that's already dropped nearly to zero can't drop that much further, right? There's no downside risk here. It may seem counterintuitive, but this stock can drop way further. Here is a list of stock splits since the beginning of 2024, and there are 340 in 2024 alone. One example of a recent stock split that took place was Nvidia. Their share price recently exceeded $1,000 per share, and since that's pretty cost prohibitive, there's not many people that want to drop $1,000 just to buy a single share. They did a 10-for-1 split. So if you had a whole cup of whiskey, right? They did their 10-for-1 split. Now you have 10 shot glasses worth of whiskey, right? You have the same amount of whiskey, you just have it divided up into a bunch of smaller amounts. If you had one share worth $1,000 before, now you have 10 shares worth $100. However, if you look at this list of stock splits, there's not very many forward stock splits. The vast majority are reverse stock splits. So what is that? It's just the opposite. You find a stock that's really low, you think, oh, it can't drop further, so I'm gonna buy 10 shares for $1 each. But if they do a reverse stock split, they take those 10 shares, they combine them into one bigger share, and now you have a tenth of the shares you had before, and the stock price is back up to $10 per share, which means it's free to drop back down to $1 once again, but now you have 90% less money. It's much more useful to think in terms of percentages. No matter what the current share price is, you can always lose 100% of whatever you put in because it can always go to zero. The second common myth is that the stock market is too risky. And this causes many investors to not even want to get started. And it's true, the market does carry some amount of risk, but not investing also carries a significant risk. In times of significant inflation, the cost of goods has gone up by more than 10% in a single year, and this has happened many times throughout history. Bonds, certificates of deposits, high-yield savings account, none of these things can keep up with hyperinflation, but the stock market can. When the cost of goods increases, the company selling those goods makes more money, and as their profits go up, there's going to be a very strong correlation over time. The stock price will follow it. Many sectors of the economy are largely insulated from inflation in this way. The only guarantee I have is that if I don't invest, I will absolutely lose money to inflation. After COVID, I noticed most of the fast food restaurants have literally doubled their prices. Chipotle, for instance, I wasn't happy when their prices went up, but I kept going. The prices went up everywhere. And then when we look at Chipotle's stock price right before COVID, they're sitting at about $18 a share. And since then, they've reached a high of almost $65 per share. This is a perfect example how a store can increase the cost of their goods and make additional profit when inflation is high. The third fatal myth has to do with age. Would-be investors don't start because they think they're either too young or too old to get started. So first of all, you can never be too young. Let's tackle that one first. Investing only gets better the earlier you start. There's a famous quote, I don't know who said it, the best time to start investing was yesterday. The second best time to start investing is right now. Because the stock market is compounding, time is your best friend. Here's how compounding works. First, a linear return is you make one stock, or a stock makes one rock per year. In year one rock. In year two, you're up to 2 rocks. In year 3, you're up to 3 rocks. That's linear. When you have compounding, each rock makes more rocks. So the first rock makes 1 rock. That's 2. And then when you have 2 rocks, those 2 rocks each make 1 rock. So now you're up to 4. And then in year 3, those 4 rocks make 4 rocks. And then in year 4, those 8 rocks make 8 more rocks. So you can see with more time comes greater and greater returns with compounding. As far as being too old to invest, that is possible, but it's pretty rare. Unless I have 5 or 10 years left to live, I am far more likely to benefit from investing money in the stock market than not. If I look at historical stock market returns, 5-year periods, 90% of them had positive returns. That means going back to the beginning of the stock market, looking at every single 5-year period, 90% chance to have a gain. Therefore, I might not invest if I only have a few years left to live. Maybe I'll just keep my money in the bank and spend it on trips and activities. But if I'm healthy, I'm gonna benefit from having my money in the stock market. The fourth fatal myth of investing is that investing is too complicated. And I can definitely see where this sentiment comes from. 10 years ago, I didn't know the first thing about investing besides buy low and sell high. I thought I needed to be a sophisticated financial analyst to be successful in investing or something like that. But I have since learned that investing is only as complicated as I want to make it. Yes, we can spend more time, more energy, we can get more training, more education, and that will lead to better results. But investing is kind of like working out. Yes, a professional bodybuilder or an Olympic athlete might have a very complicated training schedule, but that doesn't mean that I can't do a simple workout and enjoy huge benefits. The same goes for investing. If I simply put a small amount of money in a diversified index fund every week, never look at it, never touch it until I need to retire, I will be way better off than if I did nothing at all. If I just work out for 15 minutes a day, that could turn my life around if I'm previously unhealthy. Which brings me to the fifth myth: investing is too time consuming. The same working out metaphor applies here. Maybe bodybuilders work out 3 times a day with perfect nutrition and steroids, but I only need to work out 15 minutes a day for perfect results. Same goes with investing. Maybe I need 15 or 30 minutes just that first day to set up my checking account to automatically send a little bit of money to my brokerage account, and my brokerage account to automatically invest in a diversified index fund, and then I'm done. Imagine working out for 30 minutes, but your muscles continue to grow forever, even though you never work out again. That's how easy it is to invest. And your returns will actually be above average. The average investor does worse than a passive index fund. Over the 20-year period shown in this study, the average investor only got an annual return of 2.1%. Meanwhile, people who just stayed invested in an S&P 500 index fund got over 8% per year. That is a huge discrepancy. This is because inexperienced investors are buying and selling too frequently, and they're doing it at the worst possible times. They are buying when prices are high and their confidence is high, and then they're selling when prices start to fall. And they're doing it because of the sixth fatal myth: what goes up must come down. Stock prices do not abide by the laws of physics, but investors still have an intuition of inertia. And it's this feeling of inertia that makes investors sell when they see a stock trending down. Unfortunately, when there's already a clear and recognizable downward trend, the damage is already done. The stock price is already dropped, and the investor is selling low, and they don't buy back in until they're confident enough in an upward trend. By the time that they can recognize a clear and upward trend, commonly the stock price is already higher than where it was when they sold it. And we have a classic case of buying high and selling low, the opposite of what you want to do. The point is that investing is not physics. A stock that drops down may never recover, and a stock that appreciates very rapidly may never drop back down to previous levels. Market forces are much more complicated than the forces of gravity, unfortunately. So it's much simpler to just invest in a diversified index fund and stay invested and not touch it. Everyone buys a stock that drops in value at some point. The bonus fatal myth is that as long as you keep holding that stock, you haven't actually lost money. Well, unfortunately, holding a stock too long that has dropped in value can be incredibly costly. But there is a way to exit a losing position and still get something out of it. Check out this video right here where I share the best way to get out of a dead stock. Catch you on the flip side.